You need to know all these things before investing in any ETF. Stop investing in ETFs blindly. Oh God, people are going to hate this video. Hi, my name is Ognian, and in this video I want to debunk a very widespread myth about investing in ETFs. A lot of people view ETFs, especially the more popular ones, as a risk-free way to invest passively with a set it and forget it strategy that requires little to no research or investing education. They think that they can simply choose a bunch of popular ETFs, have no idea what stocks and sectors they are invested in, no idea how they are constructed, and still be safe and invest with almost no risk. And that is very, very far from the truth. Of course, if you're one of these people, it's not your fault, because you've been bombarded with that message on the internet all the time. By the end of the video, I will explain why that is and how, once you understand how marketing and advertising works, you'll be able to better protect yourself from these harmful messages. For now though, let's briefly define what an ETF is for the people who are new to investing. ETFs are basically just a basket of different companies put together according to a certain strategy and methodology. For example, the biggest 100 companies in France, or the 50 highest dividend yielding companies in Canada. That's it, nothing more. The ETF is not some magic fund put together by some financial wizard. It's not immune to crashes or dividend cuts or bankruptcies. There's no investment guru watching over your investment. It's just a basket of stocks following a strategy and methodology. This is why the fees are so low, because no one is getting in and out of positions and constantly monitoring the performance of the underlying stocks. Now, I've already said twice that the ETFs are just a basket of companies following a strategy and methodology. I just said it a third time. But what do I mean by that? Well, you have to understand that each company in the ETF is there because it fits a certain criteria that an underlying index has. And when it no longer fits it, then it is excluded and another one takes its place. For example, if you have an index following the 500 biggest companies in the USA, once a company becomes the 501st biggest one, it will no longer be in the S&P 500 ETF. And that happens automatically. In order to illustrate that better, I will do a quick research of one of the most popular dividend ETFs lately, SCHD, the Schwab U.S. Dividend Equity ETF. The goal here is to find out what exactly stands behind this ETF so that we can decide if it is good for us as investors or not, and not just blindly follow the advice of the herd and random strangers on the internet as sheep. In order to do that, I will go to the issuer's website or an ETF research platform and search for the documents of the fund. If you Google the ETF name and then go to the Charles Schwab website, you will be able to see this page. From here, you click on the SCHD prospectus. There, the fund issuer explains what the ETF is about, what are the fees, the risks, and also what is most important, what strategy and underlying index it follows. For SCHD, we find that on the first page. So, here we can see what the ETF actually represents. It says that the fund generally invests in stocks that are included in the Dow Jones U.S. Dividend 100 Index. The Dow Jones U.S. Dividend 100 Index is designed to measure the performance of high dividend yielding stocks issued by U.S. companies that have a record of consistently paying dividends, selected for fundamental strength relative to their peers based on financial ratios. Now, here is the first place where you need to stop and think. Fundamental strength and financial ratios? What strength? What ratios? If you want to be a responsible and informed investor, this is where you need to dive deeper. Fortunately, just below we can see exactly what the metrics and ratios are. To summarize, the companies need to have paid dividends for 10 consecutive years, have a minimum market capitalization of $500 million, and then they are selected by taking the highest yielding stocks based on 4 fundamental characteristics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Also, no stock can represent more than 4% of the ETF and no sector over 25%. If the issuer doesn't have that criteria, then you can go to the website spglobal.com and search for the index on which the ETF is based. When you find it, you click on the methodology tab to understand how it is constructed. Then, when you go to the document, you search for Dow Jones U.S. Dividend 100 Index, and you will see this. I will not read through it as it basically repeats the information on Charles Schwab's website. Okay, here is what the issue is. 90% of investors don't even get to this point. They open their social media accounts, they see a few short videos of people praising SCHD, and they're like, I don't need to do any more work. Here is my investment strategy, which is absolutely ridiculous. But here is another problem. If you're part of the 10% that even got to these documents, now you need to not only read, but understand what the methodology is. In the case of SCHD, the companies from the index are ranked according to several metrics. The first one is free cash flow to total debt. Then there is a second criteria, return on equity, which is the net income divided by the shareholders' equity. You also have the 5-year dividend growth rate. So now that you've read all these, what is free cash flow? What is net income? What is shareholders' equity? What is return on equity? Why do they matter? Which one shows profitability? Which one shows efficiency in using the investor's capital? Not to mention that below you have so-called buffer rules, which I will not read for the sake of the video simplicity. I'm not going to get into what all the stuff means here because this is not the purpose of the video. But what I'm saying is that if you have no idea what at least the majority of these metrics, ratios, and strategies mean, then how do you know SCHD is a great option for you? Because a talking head on TikTok or YouTube told you? Come on, you can do better than that. You work hard for your money. So it only makes sense that you educate yourself a bit before putting it at risk. And as we all know, all investments carry risk. So I have just showed how important it is to understand what actually is the strategy you are putting your money into. Next, I will illustrate a different example with another popular ETF that allows you to invest in companies all over the world and diversify your portfolio instantly, or so it seems. Here I will take a look at two other major issues that most ETF investors don't even know exist, and yet they are investing their hard-earned money blindly. Company and sector concentration and geographic diversification. But before that, if you're getting value from this video, press the like button. It helps the channel a lot. And also, in order to get any new videos I upload, subscribe and click the notification bell so that you don't rely on the algorithm's suggestions to see future videos. Alright, now let's go to the second example I want to show you. The ETF VT, the Vanguard Total World Stock Index Fund. When you read the description of the fund, it sounds really good for a person that just wants a no-brainer investing strategy to diversify across all the companies in all countries. In the ETF description, it says, the fund invests in public equity markets of global region. The fund invests in stocks of companies operating across diversified sectors. No need to know anything, no need to think about it. Just get a broad diversification and that's it. Very nice. Or is it? Let's check the top 10 holdings. Surprise, surprise. You think you are getting a diversified exposure? There are 9,628 companies in the ETF, and the top 10 represent 15.69% of the whole fund. And also, the top 8 holdings are all in the technology or related sectors. And yes, I know that technically Meta and Amazon are not in the technology sector as per the official definition, but they are all part of the mega cap big tech family. Is that good? Maybe. Is that bad? Perhaps. I'm not going to tell you or voice my opinion here. What I'm trying to say is that you need to have an opinion on the matter in order to invest in VT. But that is not all you need to understand. In order to not forget European investors who can't invest in these ETFs, here is a very similar to VT ETF that I will use to illustrate what else you need to know. It's the Vanguard All World UCITS ETF. As you can see, the top 10 holdings are the same. And the same as with VT, all of them are companies located in the USA. Now, I want you to pay attention to the countries breakdown. 57.3% of the ETF is invested in the USA. And if we check back the VT ETF, it's almost identical because, as I said, the funds are pretty much the same. 60% of the ETF is invested in the USA. So again, some new investor is getting into the ETF because they don't want to educate themselves, but hear about the broad exposure it provides. And they never even check the geographic breakdown. As before, I'm not going to say whether this concentration in the USA is good or bad. I have my opinion on it, but that's not the focus of the video. The idea is that you, the person investing in the ETF, should have an opinion on the future of USA and what is going on with the country. So let's recap our second example. A new investor looks at a Vanguard Total World ETF and thinks to themselves, great, now I don't need to know or do anything else. I just put my money there and forget it. But remember what I said in the beginning of the video? When you do that, no one is looking out for you or managing your investment. The holdings and the countries of the fund make it literally irresponsible to invest in this ETF without having an informed opinion on the USA as a whole or the big tech companies. As I said, this video is not the place for me to express my opinion on these companies or ETFs, but if you want to see which are my favorite 4 ETFs and companies for the current environment we are in, go to the link in the description and I will send you the report at your email. The report will be up to date regardless of when you watch this because I am constantly updating it. At the start of the video, I said I will explain exactly why you are bombarded with messages that make you believe that you can just ignorantly put your money somewhere without educating yourself first, and also how once you understand how marketing and advertising works, you will be able to better protect yourself from these harmful messages. So here is the dirty little internet marketing secret. When someone online is trying to get your attention, something that all marketers learn is that you have to make your audience believe that they can achieve the greatest possible result with the least possible amount of struggle. Kind of like the difference between someone advertising to you a weight loss pill versus someone explaining to you how you need to work out every day for 2 years and never eat pizza again. Which are you more likely to pay attention to? If you're like most people, you are probably going to choose the pill. Why? Because it is almost no effort and all the reward. And so, the guy who says that gets your attention and click. And then, in the context of social media or YouTube, once they got your click, even if they don't sell you anything, they monetize your attention through ads. This is why the internet investing space is full of junk like 3 no-brainer ETFs everyone should invest in, or invest in this stock and set it and forget it type of videos. Because it's sexy, easy, and it makes you click. Knowing this, I'm fully aware that my channel will get way less views and I will make way less money as a result, but I wouldn't be able to look myself in the mirror if I applied these tactics as well, because I don't think it will be in your best interest. So, what I'm saying is that the most valuable thing you can invest in is not a stock or an ETF, but your own education. Whatever way you choose to do so, whether it is through listening to podcasts, reading books, getting into an investing education program like the Dividend Method program, which I have built exactly for that purpose and where I show people how to choose ETFs, or into another one, I don't care. The point of the video is to make you understand that you need to be responsible about the money you've worked so hard to earn and not simply put it somewhere blindly without knowing the underlying basics of your investment. And at that point, when I have had this conversation with people, the most common objection I hear is, but I don't have time. I literally hate this argument. People usually try to say that they don't have time for something when what they actually mean is that they don't have A, the discipline, or B, the desire to learn the skill. But then they use time as an excuse. Out of all the people watching, probably no more than 1 or 2% of the people literally don't physically have the time for that stuff. For these people, I understand and I empathize. But for the other 98%, this is just a false excuse. People have abundant time to scroll on social media, watch Netflix, go to the cinema, drink beer with their old school buddy, or watch the World Cup, but they don't have time to educate themselves on how to manage the money they work so hard for in order to one day be able to be financially free and give their children and grandchildren a better start in life? Come on! Why are you watching Lionel Messi kick a ball or Margot Robbie do whatever she does in the Barbie movie. Making these people richer than they already are by allowing them to monetize your attention and time, instead of paying that attention to learn skills that will actually make you richer. I don't get it. Whew. So that was my little rant that I had to get off my chest. Go educate yourself, and I'll see you in the next video. What? You think they're going to hate it?